Here's a question I get from incorporated business owners and high net worth families a lot. And the question is, should I use a trust? On the surface, it almost feels like a yes or no question. The deeper question that they're asking in behind the scenes is, will a trust help protect me and my family? Will it organize my succession plan? Will it protect a vulnerable beneficiary or reduce the tax or probate fees that I'm expecting to pay on my estate? Will it keep my family wealth from being pulled apart in family court? Will it protect it from remarriage, incapacity, or creditors? And buried underneath all those questions and all those issues is a deeper root. And that is a trust still workable in Canada? That question really matters a lot because over the last 10 years, the tax rules have significantly changed. Increases on tax rates, limitations of deductions, and social media that is promoting the use and idea of trusts in general financial planning. In fact, it's a almost romanticized idea that you could put all your assets into a trust, forget about it, it's always protected, never taxed, never subject to creditors, never subject to claims against it or disintegration, and you could protect your family wealth for multiple generations. But that's not always true. Most of the trust information that we're getting on social media is US based. That means it's based on the laws of the US and the income tax code of the IRS, both very not applicable under the Canada Revenue Agency, their rules, the Income Tax Act, and Canadian law. In Canada today, the rules and income tax rules specifically around Canadian resident trusts are not gentle. Under Section 122 of the Income Tax Act, most trusts, other than a qualified disability trust or a graduated rate estate, are taxed at the highest marginal rate. In British Columbia, that tax rate is 53.5% on any income included in the trust for the year. This is not some minor financial planning detail. This is the wall you face before you even start thinking about doing anything with it. So if the only reason a client is considering using a trust in their affairs and saying, will this save me tax, or believing that it will save them tax, the question is simply misdirected and misguided. The right question to ask themselves is, what problem are they trying to solve? Because a trust is not a tax trick, the trust is a control structure. It separates legal ownership from beneficial enjoyment. It allows one person or a group of people to manage property effectively for the benefit of another. It can delay ownership. It can protect capital. It preserves discretion. And it can prevent one beneficiary from taking action that harms the rest of the family. It could be used to structure business succession planning, protect a disabled child, or move assets to a spouse. But every one of those benefits comes with tax, legal, administrative, and human consequences. So one person will hear that trusts are taxed very punitively and say, well, trusts are useless now. And the next person hears that wealthy families use trusts and say, I need one. Both are wrong in jumping to conclusions. Canada did not abolish the usefulness of trust. They raised the standard of justification to use one. Before 2016, testamentary trusts, or those that arose as a result of a will, the death of the person who was settling their affairs through a trust through their will, were taxed fairly favorably. In other words, they could access the graduated marginal rate system similar to those assessed against individuals. That made them very useful as specific taxpayers for estate and income sprinkling opportunities. But for 2016 and every subsequent year, CRA has assessed the top marginal rate, except for qualified disability trusts and a graduated rate estate. And that is the modern landscape of trusts in Canada. They're not dead, but they're not magical either. A trust may still be valuable, but the value has to come from real planning, not from vagueness or nostalgia from old tax rates. So let's start with the graduated rate estate, or the GRE. The GRE is a trust that is resulting from the estate of a Canadian individual. And provided that the conditions are met for a GRE, it can exist for up to 36 months post-mortem. There can be only one GRE for each deceased individual and it must designate itself as so by filing the annual returns of the T3. The GRE is one of the last remaining places in trust and estate planning and financial planning where graduated rates are in effect. But this shouldn't be considered a temporary family wealth machine. These graduated rates are only applied for the first 36 months of the estate. It's a short administrative and planning window. And for incorporated business owners, that timeline really matters. If you own shares of a Canadian-controlled private corporation, such as an investment company, an operating company, or an investment company, the shares simply do not settle themselves. There may be a deemed disposition on the value of those shares on your death. There may be liquidity pressure, demands from beneficiaries who are expecting to get paid out. There may be shareholder agreement issues, probate issues, creditor issues, equalization problems surrounding children who are or are not involved in the business, and timing issues regarding asset sales. A graduated rate estate will provide the estate and its executors some breathing room, but the estate still needs a strategy. The corporation still needs liquidity, and the family still needs governance. Let's move to a qualified disability trust, or a QDT. This is one of the few places in the Canadian income tax system that still recognizes something very real and very human. Sometimes a trust is not merely about tax issues. Sometimes it's about protecting a vulnerable individual from the consequences of direct ownership. A QDT has a specific tax status. CRA describes it as a testamentary trust, or one that arises on the death of an individual, and using the proper documentation jointly elects one or more beneficiaries. These conditions include, among other things, that the beneficiary must qualify for the disability tax credit in the relevant year, and that the electing beneficiary must be named in the trust document, and the trust must be a resident of Canada. A properly designed trust for a vulnerable or disabled individual can protect capital, discretionarily pay out income or capital for extraordinary expenses, preserve support and prevent exploitation from other people, and avoid forcing legal control onto somebody who may not have the capacity to handle that. So a person with a disabled child, for example, doesn't really care about the tax structure of a trust. The better and more deeper question, the more human question, is the parent wants to ask the question, who's going to provide and protect my child if I'm gone? That's a much better and much deeper, more human connective question, and that deserves a higher standard of level of planning. Within the sector or area of qualified disability trusts is the matter of the Henson Trust. A Henson Trust is not automatically a qualified disability trust. The Henson Trust, which is named after the Henson family in Ontario, is a discretionary controlled trust. And because it is not a qualified disability trust, it is taxed at the highest marginal rate again. That doesn't make the trust totally useless. It simply means that the primary reasons for setting up such a trust is for benefits preservation, protection, and control. A Henson-style trust is typically designed so that the trustee has absolute discretion over what and how much gets paid out to the beneficiary. And that matters where that disabled individual, the beneficiary of the Henson Trust, has a means-tested government benefit. Ontario's disability support policy lists Henson-style discretionary trust payments as voluntary. British Columbia's disability assistance policy recognizes that these payments are also voluntary, allowing disabled individuals and their families to protect those assets against government means-tested benefits. However, it should be made clear that these rules are provincial in scope and should be checked for eligibility. So a Henson Trust answers question of control and benefits preservation, where a QDT, a qualified disability trust, answers a more tax-related question. Now let's consider a spousal trust, and these are very prevalent in second marriage estate planning situations. Let's imagine a business owner dies and leaves behind his second marriage, but he wants to make sure that the family wealth transfers after that spouse's death to his children from his prior marriage. And without proper planning, this can become a slow motion disaster. If everything passes directly to the spouse, those assets roll over to the spouse, and the spouse could change their will, be exposed to new creditors, perhaps a new relationship. He or she may have children from a prior marriage that they may decide to prioritize through redrafting their will. On the other hand, if the spouse is cut out and all the assets go to the children from the prior marriage, that's unfair and leaves the estate legally vulnerable. So the spousal trust can create the middle path. The spouse can receive income and support prior to their death, while the other assets and capital is preserved for the next generation from the prior marriage. There are other benefits as well. CRA's guidance, and specifically in the Income Tax Act Section 76 in the Act, can generally defer taxes where capital gains or income inclusion would normally be associated with the estate on the rollover to the spouse under the spousal trusts. Now, there's some conditions under the Income Tax Act that matter for the rollover under 76. The spouse or common law partner must be entirely and solely and exclusively entitled to the use of the income during their lifetime. So if the will says, I want to provide for my spouse after my death, that wording is too loose. If the trust wording indicates that the spouse should be cared for and discretionarily pay out amounts to the children, then that excludes all the assets from the spousal rollover under subsection 76 of the Act. The surviving spouse needs protection, but the children also need clarity. So let's now consider the inter vivos family trust. Inter vivos simply means during my lifetime in Latin. These trusts are what incorporated business owners hear most often in regards to an estate planning, succession planning, or estate freeze conversation. Let's say the founder owns some significant value in the shares of their corporation. They'd like to not continue to grow those assets and move any future growth into their names of their children. Family trusts can be a way to defer any future growth on those shares through a transaction called an estate freeze. That family trust can accrue the future gains for children or grandchildren, but it also still leaves control to the founder, and they can roll over the controlling shares at a future time if they so choose. But other things are at play here, including the attribution rules, tax on shared income rules, and the highest marginal tax issues on retained income in the trust. So the family trust is neither a loophole nor a trap. The planning towards it needs to be justified. If used properly, it could be used to reduce creditor exposure, do succession planning right, and manage a control transfer of a future value. But used hastily or lazily, it's a compliance nightmare. It can create family ambiguity, tax complications, and the dangerous illusion that just because you own something or have something that's more complex, that it's more sophisticated. And then there's the layover of the 21-year rollover rule. Most people that have heard of trusts have also heard of the 21-year rollover rule, but few understand it. Broadly speaking, most trusts are subject to a deemed disposition rule. Under subsection 104.4 of the Income Tax Act, trusts are deemed to have disposed of their capital property and the taxes payable. And this is effective even if that trust hasn't disposed of the property in real life. So think about a trust that may own private company shares, real estate, a cottage, or maybe even a portfolio of securities. If the trust is deemed to have disposed of the property without any actual sale, the family will have a tax bill without any cash. That's not a reason not to use a trust, but it's one that should bring some clarity in your plan. Despite the tax trips, there still are valid reasons to use a trust. For example, trusts may make a lot of sense in a second marriage for somebody wanting to preserve their assets for their children from their first marriage. It may make sense for a disabled or incapacitated beneficiary to preserve their means-tested government benefits. It may make sense for families with significant assets where the assets should not be divided casually among beneficiaries. It may make sense when the founder wants to enact an estate freeze and start transferring control and value to the next generation of their privately held corporation. It may make sense for creditor protection issues, but it has to be done very carefully. It can't be seen as some last minute defeat to creditors of a person or their estate. For example, the Bankruptcy and Insolvency Act of British Columbia will dictate there is a 5-year look back on any transactions that have been done in order to defraud or avoid creditors. And if those transactions have transpired in the last 5 years, well, then you are going to have those assets drawn back into your insolvency. A trust may make sense in another situation, that of equalization between children. Perhaps one child works in the business and the other children or child does not, where one child wants cash and the other one wants control of the entity. In those cases, a trust doesn't exist because it magically erases the tax liability. It's there because wealth without structure can create chaos. Families never lose their entire wealth because they failed to trigger one tax solution. It gets much deeper than that. They lose wealth because they failed to plan before incapacity, insolvency, litigation, resentment, and poor judgment made decisions for them. A trust can create order, but only if it's constructed around reality. And that's why advisor collaboration on these issues is not optional. A trust should never be built into a silo. An estate lawyer is going to see the fiduciary responsibilities, legal ownership, trustee issues, family law exposure, and future disputes. The accountant is going to, on the other hand, look at attribution rules, TOSI rules, 21-year rollover rules, compliance, capital gains, corporate reorganizations, and the tax cost of getting the planning done wrong. The financial planner will see cash flow, liquidity, retirement income, insurance, beneficiary psychology, asset allocation, estate equalization, and whether the structure works in the reality of the family's financial life. The estate litigator will see where the plan can be attacked. The insurance advisor will see how the tax will arrive before the liquidity. And where trusts and estates are being contemplated, a family should seriously consider working with a TEP, a trust and estate practitioner. These individuals are certified through STEP, the Society of Trust and Estate Practitioners. STEP describes itself as a professional organization made up of accountants, lawyers, financial professionals, and other practitioners that help plan for inheritance and succession. STEP Canada says that it represents thousands of Canadians in this TEP designation and is part of the STEP Global Network. And this all matters because trust planning is not merely legal, tax, or financial estate planning or insurance work. It includes creditor protection, tax, legal, estate, and all the other necessary inputs that need to go into construct a good trust plan. And that's exactly why the answer to the question of should I set up a trust is always the same answer, and that's it depends. And that is best determined by the fact pattern of your own situation and your ability to understand how a trust can benefit your overall objectives in your family estate plan. If the purpose is merely tax savings alone, then the answer is probably going to lean to no. And the same is true as if you're looking on social media, getting your advice about trusts from US practitioners here in Canada. But if the purpose is to protect a spouse, protect capital, manage a second marriage, protect a vulnerable beneficiary, delay direct ownership, structure an estate freeze, plan for business succession, create the possibility of creditor risk protection, or create liquidity and control throughout multiple generations, then a trust may be of serious consideration. And why? Because a trust imposes order. A trust answers the question of who should control the property, for how long, for what purpose. And meanwhile, the Canadian tax system has made it a little bit more, yes, sometimes a lot more punitive for the income tax consequences of a trust, but that has not made them irrelevant. So before setting up a trust, the question shouldn't be what are other wealthy families doing, but the question should really be what happens if we don't. And I think this is where sophisticated families separate themselves from families that merely have money. They don't chase structures or products. They help define consequences and problems, and then they choose the structure that helps them solve the problem or meets their objectives. And that's, I think, where all serious planning really starts. If you found this video helpful in your journey of discovery of politics, history, economics, philosophy, and financial literacy, make sure that you give this video a like, subscribe, and hit that notification bell for upcoming videos.